The U.S. government shutdown looks to be ending, but investors are still flying blind with little data to go on. At the same time, gold is rebounding after a significant pullback, but will it last? And with the euro holding strong, could dollar weakness spill into equities? I'm Johanna Bota, and joining us today to break it all down is Alex Ridgers, VP Global Head of Retail Dealing Desk at StoneX. Welcome back, Alex.
Hello, Johanna.
So we've got a lot to talk about today, but let's start with the government shutdown, which appears to finally be over. When are we going to get some data and some news that can guide investors?
This is it, and I think this has been the focus of this week. Now we've got the shutdown done, officially it's done. We're missing a massive chunk of October data. So far, all we've had to play with is the ADP unemployment data, which hasn't really told us anything new. So, and then over the last couple of days, there's been, I think, almost the realization that there may actually be no data. So there's rumors that we'll get October data at the end of this month, end of November, early December. But now, as we get further into the week, it's like there might not be any data at all.
Right. That's what Caroline Levitt just said, right? So at the beginning of the shutdown, you predicted a pullback from gold's all-time high. And it played out exactly as you predicted, by the way. Well done, well done. Now prices are going up again, though. I guess, what do you think is driving this rebound, and will it hold?
My take is that, again, as I was saying, this sort of anonymous almost period, sort of phony period we've had, this gold pullback was like, well, what's going to change? You know, we've hit highs, maybe something will change during the sort of shutdown period.
Yeah.
We better pull off from highs to see what's going to happen. And actually, with this almost like lack of data and the likelihood of no data to come,
right,
it's almost been a case that the markets have gone, well, we're back to where we were. We know there's nothing to change the rhetoric that dollar rates are going to drop. I think we're 50-50 in December for a rate cut, and we're almost guaranteed a rate cut by January. So the lack of any other information has said, well, actually, it's more of a dollar trade than the sort of gold strength, if you know what I mean. So it's dollar weakening. Well, gold's got to rally again.
Yeah. And how do you see the outlook for the euro-US dollar?
Well, I was looking earlier this week, and I was almost perplexed. I was like, well, I can go short. You know, euro dollar, it's sort of recent highs or relatively near to recent highs. I was like, you can go short euro dollar and 1% interest on the dollar euro differential. It seems a good deal. But actually, the more I looked into trying to find, you know, why is the euro so strong? You know, over the last couple of years, we've seen Germany basically being in a recession for 2 years. The French political turmoil, and I was like, well, where is the reason to buy the euro? And actually, delving a little bit deeper, we've seen that the French economy is a little bit more resilient than we thought. It seems like the politicians are actually, you know, sort of getting together and doing something useful now. And we've got the CAC at all-time highs. I mean, not that it's rallied through the roof, but we're sort of breaching where we were in March. So all of a sudden, this idea of, you know, sort of why is euro dollar strong? It's almost a sort of balancing act where we've got this idea of, yes, the dollar is weak, but the euro is equally weak, and there's no real reason for it to budge at the moment.
Last time we talked, you talked about indices not being in a bubble. Do you think that the dollar weakness could spread to indices, but more specifically U.S. indices in particular?
It seems a bit like Groundhog Day at the moment, that every new day there's a new article saying indices, stocks are in a bubble, AI bubble, this bubble, that. So I've been looking back to see, you know, what are the precursors, what are the hints we can have that markets typically give when a sort of recession or, you know, a crash is due to come.
Yeah.
The first one is credit spreads. This is the difference between government bonds, which are meant to be the safest thing in the world, and corporate bonds. The idea being you need to get paid a lot more to hold a corporate bond, which is less safe than a sort of government bond. So the idea is when this spread widens, it's almost like traders are becoming risk averse. They don't want to take the risk. So what happens then is, for companies, their borrowing costs go up, which means they invest less or they're in trouble, which means there's less growth, which then comes back and hits equity valuation. So that's sort of loop.
Yeah.
And every time, you know, we saw it in 2001, in the dot-com bubble, 2008, and sort of the worldwide general meltdown. And then actually even pre-COVID, before indices dropped.
Yeah.
Credit spreads almost where there was a 10% gap between the borrowing of the funding for companies and governments. But this time around, credit spreads are very, very low. So they're at sort of roughly the lowest range they've been since about 2010, again, since the sort of global meltdown. So there's no sign there.
That's good.
Then two, when we're looking at, again, the sort of percentage of companies that are the highs or lows. And again, it's sort of in the same way credit spread, it's almost like a market contagion. So at the moment in the US, of the sort of the big major indices, there's only 7% of companies that are down at their sort of 52-week lows. Typically, it's almost thought about when you have 30% of companies down at this level, that almost suggests that there's a significant enough portion of companies doing really badly that contagion spreads to the bigger companies and sort of drags them down. So that's not happening.
Okay.
And then third,
2 out of 3. Okay.
yes, and then third is what I think is really sort of interesting at the moment, and as we go into December, is quantitative tightening.
What is quantitative tightening? Can you delve a little deeper into that?
Quantitative easing is the idea that governments are buying bonds, and that's putting money back into the economy.
Okay.
To give more liquidity, more money to go around. So after COVID, with a lot of quantitative easing, the Fed, well, all governments in reality, but talking specifically about the Fed here, they're sitting on huge stockpiles of bonds. So at some point they've got to get rid of some of these. So it began in mid-2022. The Fed is selling its 9 trillion, or a big chunk of 9 trillion of bonds it holds. Now, considering that the total asset value of the NASDAQ with NVIDIA and everything is only 31 trillion, it shows you quite what a stockpile that is.
Yeah.
So I think we were, by mid-2024, we were down from 9 to 7, and I think we sit about 6, or it might be a little bit lower. So essentially what's happening is that with the Fed selling bonds, they're taking, other people are giving them money, they're taking money out of the economy. So that is coming to an end on December the 1st. And so this, I think, is going to be the big thing going forward in 2026.
And so then how does that impact the US dollar?
So yeah, so what that means for both for the dollar and for indices, it's a big thing. It means that there's no more money being sucked out. There's more liquidity. So where does that go? There's no forced seller of bonds, which means bond prices go up, yields drop. So all of a sudden, safe assets aren't going to pay you as much. So you're more likely to turn to risk assets, more likely to invest in indices. So that's one take.
Yeah.
Then the other take is for the dollar.
Yeah.
Again, with less to push bonds down, which is raising yields. So there's almost nothing holding up interest rates. Interest rates fall, which means a weaker dollar. So obviously lots can change, but it's going to be really interesting come December the 1st and going through into the new year, quite what the end of quantitative tightening is going to do to the economy.
Understood. Thank you, Alex, for your time. And thank you for watching. For more financial content, don't forget to like and subscribe to our channel.